Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian equities retracing early losses and U.S. futures climb amid signs Washington will avoid a government shutdown. JPMorgan Private Bank will be with us to explain why they're still long-term positive on U.S. markets despite recent volatility. We'll be discussing earnings with the world's largest aircraft operating leasing firm, BOC Aviation, and getting their outlook for this year. Plus, we'll be speaking with a family business expert from IMD Business School after a public feud hit Singapore's richest dynasty. Those losses starting to gain some amount of calm in the markets for now after another day of losses on Wall Street, where sentiment quickly turned from optimism to nervousness, with around $5 trillion getting erased in the U.S. equity benchmark. Let's get to Avril Hong for more on the markets. Avril, the flip-flopping continues.
Yeah, so much volatility, and that is including what we're seeing in the price action today. I mean, you see how the U.S. stocks performed overnight. U.S. futures now enjoying a bounce, and this is following on from Chuck Schumer saying that they'll drop this threat to block a Republican spending bill. So this paves the way for the aversion of a U.S. government shutdown and helps to take one of the factors of uncertainty out of the equation as investors grapple with the trade war. We're seeing, as I say, stock futures up along with Asia, but that caution, I think, still remains. Will this be the day where the MSCI Asia Pacific manages to snap its 5-session losing streak? We still have a long way to go before the close of trade, and I think it's quite difficult to make a case for a sustainable rebound with the tariff policy uncertainty overhang. Let's flip the board and take a look at what we've seen in U.S. stocks, because just to highlight the S&P 500, as you alluded to, $5 trillion wiped out from the February peak. It's moved 10% from then, 10% lower. So meeting the technical definition of a correction. You look at the RSI, it's also in oversold territory. This is the most oversold indeed since 2022. The pace of the deterioration in U.S. stocks is what's been startling. I mean, just 3 weeks ago, Haas, we've been talking about stocks at record highs, right? After Trump talked up the economy. So it's quite a turn in events. Flip the board again. As we see U.S. stocks deteriorating, we've interestingly been seeing this sort of breakdown in the correlation with bonds. So the positive correlation has been eroded with bond returns rising. So that's helping investors to hedge against stock losses. Whether this correlation turns negative, really going to be dependent on the trade war and its impact on inflation, Haas.
Nothing is for certain right now, not even trends. Avril Hong, thank you. And more upsetting tariff news, especially on a Friday. President Trump has threatened to impose a 200% tariff on wine, champagne, and any alcoholic beverages from France and other countries in the European Union. The president posted on social media that he would go ahead with the duties if Brussels follows through with a tax on American whiskey exports, which was aimed at retaliating against Trump's steel and aluminum tariffs that went into effect on Wednesday.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together.
The European Union's foreign policy chief, Carla Callas, told Bloomberg that the only side that's winning from a trade war between the U.S. and the EU is China.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
Well, let's get more on markets with Julia Wang, global market strategist at JPMorgan Private Bank. She is long-term positive on the U.S. market and still sees upside. Julia, good to have you with us. We're seeing a lot of flip-flopping in the market, reflecting the flip-flopping in tariffs. But what remains certain is that those tit-for-tat moves in tariffs really impacting investor sentiment.
Sure. Good morning. Thanks for having me on the show. So definitely, I think it's been a very volatile market driven by policy volatility. We have definitely seen, I think, a lot of uncertainty with regard to how this tariff war has actually played out. It's been very different from what investors have been expecting. I think come beginning of the year, nobody was really expecting tariff to actually be implemented on so many of the U.S. trade partners at this level. And of course, we also have retaliations that were also unexpected. And as we look ahead to the next couple of weeks, we already know that there are further tariffs coming down in the pipeline, be reciprocal tariffs or more product-specific tariffs. I think all of it just makes it a really fast-moving environment where investors not only have to change their base case, but also think about what are repercussions for earnings and valuations. So all of that, I think, is contributing to what we're seeing now in the markets. Our longer-term view is rooted less in the trade policies, but more in the fundamental structures of the economy and how this cycle is ultimately different from the other economic cycles in recent years. And the biggest difference is now we have a secular trend that's AI, artificial intelligence. We do think that it is very transformative for the economy, and we are going to see the productivity increase over the next few years. So we do think that the innovative capability of large U.S. companies, their very strong earning growth can withstand the policy-induced volatility in the near term. And that's why we continue to really like this part of the U.S. market, and also to some extent globally as well. We do think that this is a secular driver of growth that long-term investors should continue to look very carefully at.
Julia, even as you cast your eye long-term, what do you do now? I mean, investors are saying perhaps they really don't know what to do. Is it about locking in profit now, sit on your hands and wait till there's greater clarity in terms of how this trade chaos will play out?
So I think there are really, two types of approach. For us, a lot of our clients are longer-term investors. We actually think that, look through the noise a little bit. Look at the companies who have nothing to do with the trade war, right? Maybe they're in the service sector, maybe they're in the tech sector, maybe they are, not doing anything to do with global trade. They're focused on domestic economies, and to that extent, these companies have also been derated very significantly because of the overall derating of the market. So we say that look at these companies, and there may be opportunities now to even buy these type of companies who, their earnings are not being affected, so they have more room to recover once the market settles and their longer-term earning outlook remains unaffected. So a lot of the tech company, both in the hardware, networking, software, globally as well as in Asia, fall into that category. And there's a second type of investors who say, I'm more tactical. What do I do right now? And we say that actually, this is basically fundamental rule of investing, which is diversification, right? If you don't know what the macro outlook is going to be tomorrow, then you make sure that you spread your bets a little bit. And cross-market correlations geographically has actually fallen over the last few years, which means that investors actually, you don't need the rest of the market to really outperform the U.S., but your volatility-adjusted returns already improves. So, you get paid to diversify. And also don't forget about other type of cross-asset diversification or hedges. So, for example, a dollar-yen, a bet on the yen strengthening could be a portfolio diversification for a certain type of event. Think about gold, that could be a geopolitical hedge. And think about U.S. Treasuries. If the U.S. equity market continues to wobble, we do think that Treasuries could work out quite well as a portfolio hedge. So these are all the things that you can think about as a tactical investor looking at your portfolio today.
Let's pick up on gold. Gold touching 3,000 already in the futures market. Is there further upside there? Because the sense out there is that gold is possibly the most stable haven when it comes to really turbulent times such as these.
We do think that the gold plays into some of the very structural shifts that are happening in the global economy. So the reversal of globalization, the fractures that we see among different geographical blocks, which means that they all have to, diversify their reserves of their wealth in another asset class, and gold is one that has historically there's a consensus that historically this is the place to be. There's also the worry over the fiscal situation in the U.S. and there's no really painless path to reduce fiscal deficit. So whatever choice that ends up getting taken, gold might actually rise through that. So there's also a diversification or a benefit if you're hedging for fiscal and sustainability, that type of events. So I do think it plays into a lot of those long-term structural worries for the global economy, which is why it has a very strong bottom. And I think versus dollar, its valuation continues to rise. The day-to-day trading will still be quite choppy because, to your point, it's gone to $3,000 already. It's a little bit of a momentum caught up in it as well, and it could be quite choppy depending on how the dollar plays out day to day. But we do think that medium term we could be in the middle of a multi-year gold bull market. So because of the geopolitical and longer-term shifts that are happening.
So where might gold get to by the end of the year if it is a haven play, if governments are buying gold because of the debt to GDP ratio, trying to fix that? I mean, where might gold get to?
So our near-term to 12-month target suggests that there's still a kind of slightly less than 10% upside from here. But we do view it somewhat more from a 3 to 5 year perspective. And I think that if you look at the longer term history of gold, they tend to grow cycles where go through periods of very strong revaluation and then does nothing for a number of years. So I think that we're probably in the middle of another bull market. So over a period of 3 to 5 years, you should be looking at much bigger gains, like 50% or even more.
Well, speaking of bull market, we know that China is in bull, but today we're seeing, some pressure. In fact, we've seen some pressure in the last few days. That correlation between the U.S. and China, might that be picking up, or could China continue with its run upwards?
That's a very good point. I think when, we've seen over the last few years that whenever the U.S. market wobbles or declines, correlation tends to pick up. Because the U.S. market sets the tone for global risk sentiment to a very large degree still. So if you continue to see near-term turbulence in the U.S. market, which is our near-term base case, we think the China market will also be quite choppy at this level. We do think that one thing that has changed the most in the China market year to date is the availability of AI technology and how the AI adoption is now more of a theme that can drive earning growth expectations for not this year, but the next few years. And that's what exactly long-term investors want to see. So to that extent, we think that this is a very positive change for the China market, and given especially valuation still quite reasonable. So we do think that to some extent, there's more room or upside for AI-related China equities for the next 6 to 12 months from here. But I think, to your point, next few weeks, we're probably still going to see quite a bit of volatility coming from the other side of the world.
So when you take a look at AI plays in China, which are the best bets? And when you compare it to the Max 7, for instance, how do you think they'll perform versus their U.S. counterparts?
Yeah, so I think that the AI angle for investing in China's AI, the angle is slightly different from the U.S. and every economy kind of has a different specialization, if you will. And China, we think that the most of the interest for us, at least, is in the application space. And that is, we have DeepSeek that's really brought down the cost curve, which enables so much more implementation opportunities. So we're going to see many companies try different experiments and see how can I monetize this large language model, which is now quite cheap? How can I get consumers to buy into this? How can I improve my margins? So AI agent is a big part of most of that will be somewhat consumer-facing. The similarity with the U.S. market could be with the data centers and the service providers for data centers. That could continue to be type of infrastructure that generates good return for the company that has a strong enough market position. So some of the large cap companies also spring to mind. So I do think that the opportunity set for China in AI application space is a lot larger because of a digitalized lifestyle. Everyone's on the internet. Penetration is very high, and people like to embrace new things. But to some extent, our investors are somewhat constrained because we can only invest within the public market, and if we only look at that, there's much less selection. But I think for the real economy, there's a lot more opportunities out there. For the public market, I think we compare the large cap Chinese stocks with their U.S. counterpart. I don't think they're really comparable to some extent because they're somewhat independent development of AI. But if you have to make a comparison on a valuation, then China is somewhat more reasonable as well. So I do think that there's still a good opportunity for investors.
One of the big gainers from the tech and AI story in China is Tencent. We're seeing gains in excess of 50%, for instance. It is out with earnings next week. What are you hoping to glean from its numbers?
Yeah, so we don't comment on single stocks as much, but I do think that investors will want to see progress or signs that the company is going to invest very heavily into AI because they are so well positioned, in this AI revolution. They're absolutely the front center of it. So investors want to see that they can grasp the opportunity. They can invest a lot into different ways to monetize AI, or at least expand usage, increase consumer engagement. We don't have to think about monetizations per se as soon as next quarter or the quarter after that. Investors can be somewhat patient on that, but I think investors do want to see, are you grasping the opportunity? Are you investing your capex? What are the things you're going to try and experiment? And how are you going to pave a path for stronger consumer engagement or user engagement, which we know is the way to unlock an eventual monetization path.
How much more upside for HS Tech, you think?
So we think that a lot of the large tech companies, even compare with 5-year valuations, historic valuations, for example, or 5 to 10 years, they're still 30% undervalued. But that's not even baking into the stronger earning growth that could potentially come out of AI. So I think that if you look at a slightly longer term horizon, 3 to 5 years, let this story play out, you could be looking at much bigger return potentials.
And Julia, before we let you go, your call is on the S&P, because we know we've had quite a few banks cutting their projection for the year.
So we're still positive on the S&P. We think after the recent pullback, we can actually look at more than almost double-digit return now for the next 12 months, which is actually a larger number than we started the year with, because we now have this pullback. We continue to think that technology companies are a little bit caught up in this tariff war, but actually the earnings are not so much impacted. So we'll be zeroing in more on that part of the market from here.
So perhaps those losses are overdone. Julia, thank you so much for your time. Been a pleasure. Julia Wang, JPMorgan Private Bank. Still ahead this hour, CEO and MD of BOC Aviation will be joining us for an exclusive conversation on earnings and the impact of tariffs. Plus, IMD Business School will be with us to discuss what dynasties can do to lower the risks of conflicts in family businesses. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Russian President Vladimir Putin says he wants direct talks with President Trump on the proposed Ukraine ceasefire, hammered out by Kyiv and Washington in Riyadh. Putin says he supports the idea, but stops short of endorsing it. And Trump seems to be holding out hope that his Russian counterpart will come around.
Yeah, I'd love to meet with him or talk to him, but we have to get it over with fast. If we get a peace treaty, a ceasefire treaty, I think that leads to peace. That's going to really lead to peace. I don't think anyone wants to go back. They've been doing this for a long time, and it's vicious and violent. And I think if President Putin agrees and does a ceasefire, I think we're going to be in very good shape to get it done.
Let's bring in Bloomberg's East Asia government editor, John Herskovits. John, I mean, we know that Trump is pretty optimistic, but chances are that quick Ukraine truce may not come together that quickly.
Certainly. I mean, Putin was very careful in his words. He said that he has left the door open for the ceasefire talks, but is also looking for a long-term solution for this. Now, he's speaking to a number of audiences. The first is President Trump. He wants to keep good relations with Trump, keep the options going, especially after the Trump administration hailed the ceasefire agreement it got from Ukraine earlier this week. But there's also concern that Putin may be trying to string this out to play for time and not all that interested in it. His forces are making advances in the Kursk region of Russia, which Ukrainian forces took, I think, in the fall. And there's also the concern of what Putin says when he sees a final solution to this conflict. Bloomberg spoke to Western security officials earlier this week who see Putin wanting maximalist demands that Ukraine and Europe probably won't abide by, like giving up aspirations for joining NATO, no European peacekeepers in Ukraine, keeping the territory that Russia seized, and also new presidential elections. So, yeah, it's Putin is very careful with his words, and there's a lot that can be read into them.
And we had the same sentiment expressed by Zelensky, saying that he's skeptical that Putin wants a ceasefire, that he wants to continue the war. I'm just wondering how much pressure the U.S. can put on Russia.
Now, we're seeing some things that are going on from the Washington front. We had Secretary Bessent saying that the U.S. is willing to put pressure on Russia and Ukraine to keep the momentum going. Also in the U.S., we had kind of a technical measure with the license agreements for energy payments, which expired March 12th. Anyway, they expired recently, and they're making it more difficult for foreign companies to buy Russian oil in foreign currency. Bloomberg spoke to a State Department official saying that this will gum up the works for payments. We really don't know to what extent this will happen, but there is some pressure being applied, but to what extent we really don't know this will affect Putin and his bargaining position.
It's quite curious that despite the uncertainty of it all, we have the U.S. now discussing details of a final agreement. I mean, put that in perspective for us.
Yeah, I mean, the U.S., Trump has been looking for some sort of agreement rather quickly that could end this conflict. He's said that he wanted to get this done from day one. He's extended that deadline. So the U.S. really wants to see this happen. And whether it will or not is another matter. Zelensky said in his comments he sees Russia as trying to keep the war going and keep as much as it possibly can. So we'll see where this proceeds from here.
John, thank you so much for that. Bloomberg's John Herskovits there. Stephen Townend, CEO of BOC Aviation, Asia's largest aircraft operating leasing company, will be joining us with his outlook for the aviation sector amid tariffs uncertainties. This exclusive conversation is coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. With Trump's tariffs dominating the conversation, global businesses are weighing the changing landscape. That's true for airlines and aircraft manufacturers alike as they grapple with consumer confidence and supply chain pressures. Some of the biggest U.S. airlines are warning of a slowdown in travel demand and slashing growth expectations for the first quarter. Joining us exclusively is Townend, CEO and MD of BOC Aviation. This is Asia's largest aircraft operating leasing company. Stephen, good to have you with us. We're talking about the U.S. and how perhaps, that remains intact despite the fact that, the expectations we could see a slowdown. You're just back from the U.S. What are your conversations like? What are they suggesting to you?
Good morning, Haslinda. It's good to be back. When I was in the US last week and meeting with a number of the US airlines, whilst they're seeing some weakness in short-term bookings, at the moment they don't see this as being something permanent. They think it's just a reaction to some of the volatility around them, and none of them at the moment are adjusting their long-term earnings outlook. So
it's going to be pretty strong there, and that's going to be reflected in Asia as well.
If we look globally for this year, if we look at IATA, which its members I think account for about 90% of all airline traffic, what they're forecasting for this year is record earnings globally across the airline industry. I think it's going to be close to $37 billion of profits, and profitability actually in all regions as well.
You talk about record earnings. You had record earnings. Was that driven partly by, the supply chain uncertainty, supply chain disruptions, and that's resulted in higher yields for you?
It's really two things for last year. Yes, it was record earnings. We're very happy about that. We're up 21% year on year. We had growth in our core business, so earnings were up 16% in the core business. We also had some recoveries of write-downs that we'd taken previously related to Russia, which we were able to recover now 100% of the write-downs that we took. And I think we're the only leasing company globally that's been able to achieve that so far.
So you've not quite benefited from those supply chain disruptions. Might that feed through this coming year? Might you see another record earnings on the back of that?
I think what we will see for this year is that does start to feed through more. So if we look at the dollar volume of aircraft deliveries, so last year, 2024, globally, about $80 billion of aircraft delivered. And for context, that was still below 2018 levels. So the supply chain has been struggling for a number of years. But we see that increasing this year by about 25%, up to about $100 billion. And so as we start to get more of those deliveries coming through, we should begin to see the benefit of those increasing yields.
So we've seen the worst of the supply chain disruptions?
Hopefully, yes.
What's driving that optimism?
I think that we're seeing a lot more stability now at both Airbus and Boeing in terms of their ability to build aircraft and deliver them on time. We've seen month on month for the last few months, both of them ticking up in terms of the number of aircraft that they're delivering. I think that there are still a lot of challenges in the supply chain, but we're seeing a lot more stability than we've seen for the last 2 or 3 years.
You talk about challenges in the supply chain still. Where exactly, and how optimistic are you that these can be addressed soon?
The primary area where we're seeing it is on engines. I think all of the engine manufacturers are still having difficulties getting back up to the level of deliveries that they want to see. Mm-hmm. Elsewhere, some of the seats, particularly the premium seats, we're seeing delays. And this is going to take a long time to work its way through. If you go back to 2017, before all of these challenges started to occur, and you look at what were people forecasting would deliver over the next 10 years, and you then compare that to what has delivered so far and what the major manufacturers think they can deliver between now and 2027, the world is about 5,000 aircraft short of what was forecast to deliver. And so on an installed base of about 25,000 aircraft, it's about 20% short. And so even if they are able to ramp up in the way that they want to, this is still a multi-year issue.
5,000 aircraft short, yet we're seeing a pickup in demand, as we've seen in the U.S. as well as Asia, as you said earlier. I'm just wondering whether you see, this shortage accelerating because, when it comes to Airbus and Boeing, they've already seen really massive backlog in terms of orders.
They've got this huge backlog. I think their backlog today is worth about $1.2 trillion, and that runs out beyond the end of this decade. But they're ramping up, and so they're anticipating increasing production markedly year on year as we move forward. So it'll help to cut into that deficit, but I still don't think we'll get fully back into that completely balance of supply and demand really until somewhere near the end of this decade.
What can help? Can China help, for instance? Can its aircraft, its manufacturer, help with it?
So, COMAC is building a good aircraft. The aircraft is now in operation. There's actually still only 16 aircraft in operation as of today, but it is flying and it's starting to build that operational knowledge that comes with it. The challenge, though, is that they're still reliant on the same supply chain. And so it's the same engines that you have the same engines on the Airbus aircraft, the Boeing aircraft, and the COMAC aircraft. The avionics come from a similar place as well. So they have that same supply chain restriction, which means that they can't suddenly step into the gap in a huge way.
But when it comes to COMAC's capabilities, how much of that slack can COMAC pick up realistically?
I think they're ramping up, but in a measured way. This is their first aircraft program of this type, and so their current plan is to get, by the end of the decade, to be delivering about 150 to 200 aircraft a year. But in the context of a global fleet of 25,000 aircraft, that's still a relatively small number.
Stephen, how much confidence is there in COMAC when it comes to, those outside China? I mean, is there confidence in what COMAC can deliver, which could eventually translate to bigger orders for COMAC jets?
I think if you look what's happening so far, so the plane is in operation, it's operating well. The plane is not certified to fly anywhere outside of China at the moment, so nobody else knows. But this is not the first aircraft that they have built. They have built other aircraft over the years. It's just really the first mainstream product that we have seen. And so they do have a long track record. Clearly, it takes time to build that confidence. It took Airbus a long time to build that confidence when they first came into the market. But there is no reason why they shouldn't get there.
So what? We're talking about a 5-year time frame, a 10-year time frame, or it's going to take longer than that?
A lot of it will depend on when they can start to get the aircraft certified elsewhere. And it's an operational issue, but it's also a political issue. And so we have to wait to see how that feeds through, because it's only really once the aircraft is flying elsewhere that it builds that global confidence as well.
We've been so preoccupied with the Trump tariffs, and I'm just trying to wonder. I'm wondering how you're assessing how the industry will be impacted by it.
It'll be interesting to see, because tariffs tend not to be just sweeping across everything. And so if we look at what has happened so far between the US and Canada, between the US and the EU, broadly, aviation has been exempted and aviation has not been caught. The tariffs don't apply to aircraft engines, to aircraft parts. Really, the only thing we've seen affect aviation indirectly so far have been the steel and aluminium tariffs. And there was some analysis done a couple of weeks ago, I think it was by Citi, and they said at most that's the effect on aircraft prices is still less than 1% of the aircraft price.
But what are conversations like among aircraft manufacturers and airlines, given that Trump is currently putting tariffs on just about everything? I mean, it's not inconceivable that tariffs could be implemented on aircrafts.
It's not inconceivable.
What are conversations like?
I think all you're trying to do, and this is not new, remember, because if you go back to the previous Trump administration, whereby we had the disagreements at the WTO between Boeing and Airbus, and so the same conversations were happening then, and they never came to pass. And so there's a lot of headlines, but not a huge amount of fact and coming through yet that people can rely on. Yes, if you take an extreme example of 25% tariffs, blanket tariffs on everything on the price of an aircraft, then that becomes a large amount of money. But I think we're still some way from that happening.
Is there a sense that Boeing could be the winner if Trump decides to impose tariffs on Airbus, for instance? After all, he's taken a pretty hard-handed approach when it comes to the European countries.
What we always have to remember is that the aviation supply chain is a very complex and very global one. And so it doesn't matter whether you are Airbus, Boeing, or COMAC. An aircraft is made up of approximately 10,000 parts, most of which are not built in the country where the aircraft is finally assembled. And so a lot of different parts are crossing borders in different directions. And so in as much as a Boeing aircraft will have many parts on it that have come from outside of the US, and so could be hit by the same tariffs as an Airbus aircraft or a COMAC aircraft if that came to pass.
I'd like to take a look at travel demand. We've seen quite a number of incidents among airlines, and I think we had an explosion reported just this morning. I'm just wondering whether that would impact the appetite to travel. Might that impact in the US? Might that impact, travelers in Asia as well?
Fundamentally, travel is driven by two things. It's driven by demographics and it's driven by trade flows. So to the extent all of this starts to affect trade flows, yes, it will affect traffic. But we're really not seeing that yet. We're still seeing global traffic well up on certainly last year, but also well up on 2019 levels. So I don't see that so far.
And how is it being impacted by the fluctuations in currency?
The currency issue is it affects airlines differently in different parts of the world. If you are a US airline, most of your cost is US dollar based, whether that's the price you're paying for your aircraft, the price you're paying for your fuel. It can affect airlines in other countries differently depending on how their own currency moves against the US dollar. Whether you have a strong dollar or a weak dollar can affect you differently. If a lot of your cost base is dollar denominated and you have a strong dollar, that can work against you. A weak dollar can actually help.
And the biggest risk for the industry this year, 2025?
The biggest challenge for the industry, I think, is still getting aircraft delivered. I think that if I look at our business, if I talk to many of my airline customers, they would love to have more aircraft than they currently have. They want to be increasing that transition to the latest generation, most fuel-efficient technology, and they haven't been able to do so. And so that the biggest challenge is seeing that continued stability in the supply chain that enables the industry to get the aircraft that it wants to have so that it can continue to grow.
And how is BOC positioning for that, to capitalize on what's happening right now?
So it's two things. Fundamentally, we offer two products to our airline customers. We can either give them an aircraft if they want additional capacity, or we can give them money to help finance their own deliveries. So we have our own order book in place. We're currently contracted to take delivery of 47 aircraft this year, all of which are placed with customers. Equally, we have over $6 billion of available liquidity, so to the extent our airline customers see opportunities to get additional aircraft, we can also help to finance those for them.
All right, Stephen, thank you so much for joining us today. Stephen Townend, MD and CEO of BOC Aviation. Well, up next, our next guest thinks there are many successes in Asian family businesses, but very little succession. Marleen Dieleman from IMD Business School will be joining us ahead. Keep it here with us. This is Bloomberg. Welcome back. We're tracking Chinese markets and we're seeing dip buyers getting in, extending the rally that we're seeing in China. Of course, China looking at the highest level this year. We've seen how those tech stocks have been helping China get to where it wants to in terms of the stock market performance. The Hang Seng currently up by 2.5%. Richest Tech also extending those gains in Hong Kong, China. 8 shares, well, an outperformer today, higher by 3%. We have China vowing financial support to boost that consumption, and that's according to the National Financial Regulatory Administration. So all good news in support of consumption, which has been pretty lackluster. Now, elsewhere, Asia's wealthiest clans have been prone to clashes within the family that are partly caused by a lack of succession planning. Recent examples include the Kweks family's boardroom coup in Singapore, the Ambani brothers' succession spat, and of course, the Lee family's fight for a multi-billion-dollar stake in Samsung. So what do family business leaders need to do to secure their legacies? Marleen Dieleman is a family business expert and professor at IMD Business School. She's helped many Asian business families with their transformation journeys. Good to have you with us.
Thank you for
inviting me. We tend to focus on the spats in Asia. Does it happen more in Asia versus the US and Europe, for instance?
Well, it also happens in the US, but in Asia we do see a couple of very prominent feuds coming up. We also have to remember that many family firms are uneventful in their successions and we never hear about them. But there's some backgrounds behind the feuds that we are seeing. For instance, many of the Southeast Asian and also South Asian firms are in the second to third generation, and that's a really, really tough generational change to manage.
And of course, we're talking about generational change at CDL. That's come to the limelight. I mean, how are you assessing what's happened there?
Essentially, there has been a public fight between the father, who is the executive chairman, and the son, who is the CEO, and they have put out media statements, hurtful media statements against each other, and also a court case, which was recently dropped. It's a very sad case. I believe they have gone to the extent that trust is breached, and even though the court case was dropped, I don't think that means the conflict has ended. It will take a lot of time to heal family bonds once it has gone to this level.
The damage has already been done when it comes to impacting investor sentiment as well, in terms of perhaps how, questions arising on how, the company might be managed or not. I mean, what's the key takeaway from that?
I think when you invest in family firms, it's also very good to see how strong the commitment to corporate governance is, how strong is the board. I think family conflicts are always a risk in family firms, but we also have to remember that family firms are wonderful. There are many positive features about them that makes you want to invest in those firms.
What are how do you address those feuds? How do you ensure that they don't happen to the extent that we've seen so far? Is it about proper succession planning?
Yes, that's one thing, but I would say the answer is governance. Especially when you go from second to third generation, it's really, really important to prepare for that with continuous investment. So because the risk of conflict is so high, you need to invest as much in it as other types of risk, like economic risk, that you would consider in your business. And for families, that means developing family governance. And that involves writing family rules. Families often create constitutions. They specify who takes decisions or what matters. And the more you get more practice in doing that, especially where you have a lot of family members around, the less are the chances of evolving into a conflict like this one.
In the case of CDL, we saw how a board director, a board member, was also a friend. I mean, are there questions about whether or not that is a practice to be adopted by the companies?
I think taking a step back, families often prioritize control and discretion over decision-making, which doesn't sit so well with corporate governance, which really tries to establish checks and balances. But I think I like to take another angle. I think it's a missed opportunity to have a lot of friends in the board, because what you really want is to grow your business in areas where you don't have the competence. So looking for very strong board members who are very different from your trajectory, your country, your expertise would be a very good step and beneficial to the business. And when you invest in family firms, the composition of the board and the strength of the board members is also a very clear indication of the type of family that you're dealing with.
Marleen, how do you recover from something like this? How do you instill confidence back? And some are also suggesting that perhaps such family feuds is actually an opportunity for innovation, for instance, for further growth.
Yeah. Yeah, some families, after they have a conflict, they are able to take the steps that they weren't able to take before. We don't know how this will play out, but I think we will need to have more signals that the conflict is in fact resolved and the family is able to take decisions
But
together.
what would you like to see to instill confidence?
Well, in this case, one very important aspect of this feud is that the father is quite advanced in age, and it is not so clear whether the CEO can really take the reins. I think maybe a real succession in the sense that we still want the elders around, but more as advisors and mentors. So a signal that there's somebody clearly in charge would be great. Yeah.
Do you expect to see more such feuds in Asia?
Yeah, I do. Because
Why?
many of the family businesses are in this second to third generation phase, and I see many of them are unprepared. And with that, I do think we will see more feuds. It will result perhaps in splits, sometimes in conflict, sometimes in underperformance. So it's really worth investing by families in family governance to avoid it.
Are there family businesses in Asia that have done well?
Yes.
Any models out there?
Absolutely. I mean, there is an organization called Family Business Network Asia where families can join and exchange information. I just made a video with the Tolaram, family behind Tolaram. They have done a very good job on various successions. So there are many examples.
What does doing a good job entail? What have they done?
It means investing in your governance, having a very long trajectory of establishing rules, deciding how to take decisions, who is involved in what decision, what role can you take in the business or not, what does it mean to be only a shareholder or also an operator in a family business, and then being very disciplined about practicing that. And when you do that, succession becomes much easier.
What is the biggest challenge to getting there?
I think it's awareness. Once people are aware that this is relevant, they will be able to dedicate the time that is needed to invest in family governance. It's a journey, it's not a one-off.
Are there differences in the way Asians do succession planning versus the rest of the world?
Yes and no. I mean, the basic phenomenon is the same, but one very important feature is do people retire, and if so, at what age do they retire? We see a lot of patriarchs in Asia, and also they stay on for quite a long time. And I sometimes cheekily call this the King Charles problem, because when you finally get the reins, you are already at retirement age yourself. So it risks having this lost generation. And I see a lot of this lost generation problem out here in Asia. So I always think that stepping back is extraordinarily hard, and it needs planning. So succession is not just about the person stepping up, but also how to step back. That's an art in itself.
And I'm just wondering as well whether it is worth having more professionals within the organization to help guide where you go from there.
Yes, most families do have professionals to guide them in their governance. Also, of course, in the business in terms of running parts or the entire business. I think when you become more complex as a business and also as a family, that's when you start to involve much more professional support to stabilize the family business.
All right, Marleen, thank you so much for joining us.
Thank you.
It's been a pleasure. Marleen Dieleman of IMD Business School. Back to markets, take a look at where we are. In terms of those U.S. futures, we saw them in positive territory. Of course, a reversal from what we saw earlier on. We have S&P futures up 0.8%. Russell 2000 Dow Jones also in positive territory. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.